Is the US economy as strong as the headlines claim? Or are we looking at a stage where the props are shiny but the floorboards are rotten? If you've ever watched the market rally and thought it felt a little too perfect, you're not alone. Because when you peel back the numbers, what you find is not always growth, it's often theater. And in this theater, the ticket price can be your savings if you don't know the script. Think about the last time you saw markets climbing, experts smiling, and data painting a picture of strength. It felt safe. It felt like opportunity. But what if the very people telling you it's safe are quietly preparing for the opposite? Big investors with decades of success have been stepping back, selling and holding cash, names you've known for years. People who have built fortunes on spotting risk before the crowd. And yet, in the same moment, everyday investors are rushing in. Why would the pros pull out while the headlines cheer? That's not a mistake. That's positioning, because the market has a way of pulling you in when the music is playing, only to stop the music when you're inside. And when that happens, you either have a chair or you don't. The next few minutes will show you how this game works and how to stop playing by someone else's rules. Some of the most respected names in investing have been missing out on rallies. Warren Buffett's Berkshire Hathaway saw profits drop sharply in the last quarter. His cash holdings hit record levels. Critics joked that he was done, more interested in relaxing than competing, but he wasn't alone. Ray Dalio, Jim Rogers, Jamie Dimon, big names on Wall Street, also sold large portions of their U.S. stock holdings. Some cleared out their positions entirely. They didn't buy back in when prices dipped. On the surface, it looked like they miscalculated. But these are people who built empires by reading the market better than almost anyone else. If they stayed out, they had a reason. Meanwhile, small investors who bought at the lows made quick gains. They looked smarter than the legends. For a moment, it felt like the old guard had lost its edge. But in markets, first impressions are often wrong. When experienced players step aside while others rush in, it's worth asking why. Sometimes the smartest move is to wait quietly for the perfect moment, and that moment usually comes when the crowd least expects it. One of the most important signals for the U.S. economy is the monthly jobs report. The non-farm payroll number shows how many new jobs were added. For decades, it's been a key measure of economic health. Over 100,000 new jobs means a strong labor market. Under 100,000 means weakness and rising unemployment risk. In May and June, the report showed over 140,000 new jobs each month. It looked like the job market was thriving. Investors felt confident. The economy seemed solid. Then came July. The number dropped to just over 70,000. That was less than half of the previous months. But the real shock came later. The government revised the May and June numbers. They weren't 140,000 at all. They weren't even close. May had only 19,000 jobs. June had around 140,000 on paper, but the adjusted data brought it down dramatically. It meant that for 3 months straight, job growth was far below the healthy threshold. The official story changed from strong growth to barely moving. And these corrections weren't uncovered by outsiders. The government admitted the original numbers were wrong. They even removed the head of the department responsible for the data. When fake strength is no longer needed, the truth comes out. And once the illusion fades, the market can look very different. After the market drop earlier this year, the government needed a rebound story. Strong job reports helped create that story. Confidence returned. Investors believed the economy was healthy. Stock prices climbed. But it wasn't just about data. Money had to flow into the system to push prices higher. That's where short-term U.S. Treasury bonds came in. Investors bought these bonds, then used them as collateral to borrow cash from banks. Banks then used those same bonds as collateral to borrow from the Federal Reserve. This created a chain of leverage. The same dollar moved through the system multiple times, making it look like far more money was available. It was like passing one coin around the table and counting it as new each time. With this extra liquidity, the market had fuel to rise quickly. Even if the real economy wasn't improving, prices could still go up. Leverage can amplify gains, but it also amplifies losses when the cycle reverses. The more Ite Eurobsits used, the bigger the impact when the music stops. When you look at U.S. stocks, you can't just watch the index. You have to watch the U.S. dollar at the same time. There are 4 possible combinations. The dollar goes up and stocks go up. The dollar goes down and stocks go down. The dollar goes up while stocks go down. The dollar goes down while stocks go up. Only one of these is ideal for a strong, lasting rally. That's when both the dollar and stocks rise together. It means international money is flowing into the U.S. market. It means your gains aren't being erased by currency drops. If stocks rise but the dollar falls, you can lose value when converting back to your own currency. If the dollar rises but stocks fall, your investment loses in price even if the currency helps. And if both fall, it's a lose-lose situation. This is why some investors sit out even when stocks are climbing. They're waiting for the alignment that multiplies returns instead of cutting them. Patience in these moments can be more profitable than chasing every rally. Market traps often follow the same pattern. A sharp drop creates fear and pushes investors out. Data is released showing strong recovery. Prices rebound fast. Confidence returns, FOMO builds. People rush back in, afraid of missing the next wave. Then, after enough money is in the market, bad news is revealed. The foundation under the rally is shown to be weaker than it seemed. The same reports that looked positive are revised downward. What was presented as growth is shown to be temporary or false. Prices stall or reverse. Investors who jumped in late find themselves stuck. Their money is tied up. They can't exit without taking a loss. This is how the trap closes. It's not about one piece of news. It's about timing the reveal so that the maximum number of people are caught inside. Those who entered early enough can exit with profits. Those who came late often pay the price. The best opportunities in US stocks come in rare windows, when the dollar is rising and the stock market is also in an uptrend. This combination attracts global money. It strengthens both asset prices and currency value. Investors gain from market growth and from currency appreciation. In these moments, holding US stocks can be highly rewarding. But outside of these windows, gains are harder to keep. A falling dollar can quietly erase stock profits. A rising dollar with falling stocks means your capital is shrinking in asset value. When both are falling, losses compound. The goal is to enter when both are aligned in your favor, and to exit when the alignment breaks. One well-timed entry can create years of compounding growth. It can outweigh many smaller trades and missed rallies. The key is not chasing every move, it's waiting for the right one. When the timing isn't right for US stocks, there are still ways to grow wealth. Shifting capital into assets that move differently from the market can protect gains. Gold, certain foreign currencies, and select commodities can hold value when stocks and the dollar are out of sync. Holding cash in a stronger currency can also be a strategy. The goal is to keep capital ready for when the right market conditions return. Avoid forcing trades just to stay active. Every unnecessary move increases risk without improving returns. Watching both the dollar index and stock market trends helps spot when alignment is coming back. Being early is not the goal. Being right at the turning point is. Entering too soon can tie up capital during sideways or falling markets. Waiting for confirmation reduces the chance of getting caught in false rallies. Missing one rally is far less damaging than getting trapped in a downturn. A long-term wealth strategy doesn't require winning every trade. One large win can cover several small losses. The power comes from compounding the profits of those big wins. This is why capital protection matters as much as growth. Avoiding large losses keeps you in the game. Using a safety margin in every trade allows you to survive drawdowns. Even if you lose multiple times in a row, one well-timed win can put you ahead. This approach removes the need to constantly guess the market's next move. You focus on identifying high-probability moments. You preserve resources for when those moments appear. When conditions align, you commit with size and confidence. The combination of patience, protection, and compounding is how wealth is built over decades. It's how you move from unstable gains to predictable growth. Do you like this personality? Shifting from a fear of missing out to a mindset of strategic patience changes results. You stop chasing every market move. You start filtering opportunities based on both price action and currency trends. Before entering, ask if both the dollar and stocks are aligned in your favor. Check if the move is supported by real economic strength or short-term leverage. If the answer is no, you wait. While you wait, you keep capital in safe, liquid positions. You track market signals without emotional attachment. You avoid getting pulled into rallies that don't meet your criteria. This discipline keeps you ready for high-quality setups. It also reduces stress, because you're acting on a plan instead of reacting to noise. The market rewards those who think before they act. Every decision is guided by probability, not hope. This is how you stay in control, no matter how loud the headlines get. The passive path is about building wealth without unnecessary risk. It's about protecting capital while waiting for the right alignment to strike. The same principles apply whether you are trading stocks, currencies, or other assets. Track the dollar index, track the major stock indexes. Look for the rare periods when both are moving in your favor. Those are the moments to act with conviction. Until then, position yourself in assets that preserve your buying power. This keeps you from being forced out of trades at the wrong time. It allows you to take advantage of big opportunities when they appear. Like, subscribe, and comment to share your thoughts. Share this video with someone who is jumping into the market without a plan. Stay patient, stay prepared, and keep following the passive path. Wishing you the discipline to wait for the right moment and the confidence to act when it comes. Feel free to explore other videos on the channel for more insights. See you in the next one.